Welcome to Chapter 18 of Intermediate Accounting 2, Chapter 18 dealing with income taxes. In this chapter, we'll talk about why we care. So, income taxes is a significant part of business planning and significant commitment of the resources of a business to pay their regulatory obligations. So, it's quite important, and the tax rates are in the order of 30 to 50%. So a significant amount of the earnings from businesses go to pay the tax man or the tax authorities in any event. So that's one issue. That's one thing we need to understand is the importance of the issue. We also talk about the difference between accounting income and taxable income. So talking about temporary differences or permanent differences between accounting income measures or accounting determinations of when transactions should be recorded and when they're recorded for the tax authorities. Essentially, accounting is accrual, tax is cash for the most part. So we'll talk about the difference between those two. We'll talk a little bit about taxable income and how it drives current income taxes. And then we'll talk about taxable temporary differences and deductible temporary differences. Taxable, of course, on the revenue side, creating deferred tax liabilities, and deductible temporary differences on the expense side, creating deferred tax assets. Then we'll talk a little bit about the deferred tax assets and liabilities and about the deferred tax expense which is associated with them. We'll talk about the effect of changes in tax rates, of multiple tax rates. We'll talk about loss carrybacks and loss carryforwards. We'll look at the proper disclosure and presentation in the statement of financial position, and we'll talk about differences between ASPE and IFRS. So those are the major areas that we're going to talk about. So let's begin. This is sort of a graphical representation of where we're going to go with today's discussion. And so we start with the idea that Chapter 18 addresses issues related to accounting for income taxes. Taxable income is computed in accordance with the prescribed tax regulations and rules, whereas accounting income is measured in accordance with GAAP, which could be IFRS or ASPE, and those guidelines are found in the CPA Canada Handbook in Section 3465 for ASPE, and Section 3465 is based on an asset liability approach to the recognition and measurement of accounting elements consistent with the approach taken in Part 2 of the ASPE regulations, the ASPE standards, Section 1000, essentially focusing on the matching concept. This approach differs from the revenue expense or income statement view that was the basis of its predecessor, so now we're using a balance sheet approach as opposed to an income statement approach. ASPE permits uses of the taxes payable method as well. However, the deferred income taxes method is permitted. IFRS requires use of the balance sheet liability method and is very similar to the future income taxes approach under ASPE, but it uses the term deferred income tax as opposed to future income tax, which is the term used under ASPE. So due to the fact that tax regulations and generally accepted accounting principles differ in many ways, taxable income and accounting income frequently differ. And so the following represents some examples of events that can result in such differences. Amortization or depreciation computed on a straight line basis for financial reporting purposes is computed on an accelerated basis for tax purposes. So CCA, capital cost allowance, is the tax term for depreciation for tax purposes. And so they're based on the declining balance approach. Secondly, income recognized on accrual basis for financial reporting purposes is usually recognized on a tax basis or a cash basis for tax purposes. Another example, warranty costs. Warranty costs are recognized in the same period as the sale for matching purposes, but for tax purposes, they're only recognized as the warranty work is performed, so as cash is actually paid for the service of supporting our products through warranties. So once taxable income, or taxable profit as it's referred to under IFRS, is calculated, then tax payable can be calculated by multiplying taxable income times the current year's tax rate. So tax payable is equal to the current income tax expense. Now we move on to deferred or future income taxes. Well, I'm not quite there yet. Accounting income is a pre-tax idea, and it's determined according to the financial accounting standards. The objective is to provide useful information to the users of the financial statements. The tax code, the Income Tax Act, and regulations are designed to determine income tax payable for the purpose of collecting taxes which fund government operations. So accounting income is not usually the same as taxable income. So to determine the taxable income, companies prepare a reconciliation. We start with accounting income. We add differences between the two, permanent and temporary differences, and that reconciles to taxable income. Then applying the taxable income, or applying the current tax rate to the taxable income, gives us our tax payable and our current income tax measures. So an example, for 2017, accounting income was $70,000 for accounting purposes, but only $40,000 for tax purposes. Revenue was $130,000 for accounting purposes, whereas tax was only $100,000. So that could be something like accrued revenue in accounts receivable. So for tax purposes, it's only recognized when the cash is received. Expenses are the same in this example for both expenses under accounting and under tax purposes. So in order to adjust between accounting and taxable income, in 2017, we would start with accounting income, and then we would adjust for revenue which is taxable in a future period, often because it hasn't been collected yet. So $30,000 deduction gives us taxable income of $40,000 in 2017. Tax payable, we're assuming a 25% rate. Tax payable would be $10,000. Then in 2018, we would have, we assume accounting income of $70,000 again. But in this case, we have a reversal. So in this case, we've collected more of our accounts receivable than we have left at the end of the year. So that would actually result in a reversal of the revenue adjustment, and it would actually increase income, so that our taxable income was a higher number, be $90,000, taxes payable $22,500, 1/4 of that amount. And then in 2019, the other $10,000 comes back, or is reversed, so that we increase taxable income by $10,000 to become $80,000, and the taxes payable is $30,000. So this is an example of a timing difference, which is it arises in the first period, and then it reverses over the next two periods. And that is an important distinction in accounting for income taxes. Reversing and permanent differences between taxable and accounting income can be characterized as either a reversing or temporary difference, or a permanent difference. Reversing differences are those where the accounting treatment and the tax treatment are the same, but the timing of when they're included in accounting income and taxable income differs. Reversing differences usually result in a temporary difference between the tax basis and the carrying amount of an asset or liability. So that's referring to the balance sheet kind of approach. So the carrying amount on an asset or liability on the statement of financial position may be different from its tax basis, and that would result in a temporary difference. The temporary difference is an accumulated difference to date. So a statement of financial position concept, whereas a reversing difference relates to the change in a temporary difference in the period, and is therefore more of an income statement concept. So reversing differences are treated the same for books and tax, but in different periods. And so that's the income statement differences. The balance of a temporary difference changes from period to period. So an example of this would be something like the amount of capital cost allowance deduction. So you could have you could have an originating timing difference, which is the one that happens in the first period. So in our example, That would be the $30,000 non-taxable revenue in 2017. And so that was the amount that reversed over the next two periods. The originating timing difference was the initial difference between accounting and taxable incomes. And then the reversing timing difference is when it was accounted for or reversed. In the same way that accrual entries are reversed, the timing difference also reverses over time. So all of the items that we discussed previously can result in differences between amounts reported for book purposes or accounting purposes and those reported for tax purposes. A temporary difference then is the difference between the tax basis of an asset or liability and its reported amount in the financial statements. So it results in taxable amounts or deductible amounts in future years when the reported amount of the asset is recovered or when the reported amount of the liability is settled. So when the carrying amount of an asset or liability differs from the tax basis, resulting in a temporary difference, the future tax effects on taxable income must be reported in the current financial statements. I'm not sure we want to move ahead quite yet. So temporary differences arise where the tax basis is different from the reported amount or carrying value in the financial statements. And that difference will reverse and result in taxable or deductible amounts in future years as the asset is recovered or the liability is settled. So temporary differences originate in one or more periods and reverse or turn around in one or more subsequent periods. So for example, when a company records a product warranty liability, an expense is recognized for accounting purposes but not for tax purposes. And in the year this happens, this is an originating difference that results in a temporary difference on the statement of financial position. And so in future years, when the company makes good on its product warranty by actually paying it in cash, tax deductible amounts result, which reverse the effect of the originating difference. So two concepts related to temporary differences are originating differences and reversing differences. An originating difference is the initial temporary difference between the carrying amount and tax basis of an asset or liability, regardless of whether the tax basis of the asset or liability exceeds or is exceeded by the carrying amount of the asset or liability. So it's basically a difference. A reversing difference, on the other hand, occurs when a previously recognized temporary difference is eliminated in whole or in part, and the tax effect is removed from the future tax account. So in the depreciation example, or in a depreciation example, we might have the case where early in the life of an asset, the tax depreciation was substantially higher than the straight line accounting depreciation. So as a result, we're recording a deferred tax liability, and then because we're essentially reducing the amount of taxes we're paying on our accounting income, and so that tax liability would be changed at the time when the straight line depreciation caught up to the total CCA capital cost allowance deduction for tax purposes. So the reversing difference, the originating difference is when you buy an asset and you first depreciate it for its first period under CCA, the CCA deduction being higher than the accounting expense related to that asset. And then reversing differences happen as the asset is used over time, and the difference between the accounting and tax basis for amortization or depreciation reverses. Permanent differences are different. Permanent differences are caused by items that enter into the calculation of accounting income but never into the calculation of taxable income, or items that enter into taxable income but never enter into accounting income. So since permanent differences affect only the period in which they occur, they don't give rise to future taxable or deductible amounts, and as a result, there are no future tax consequences to be recognized. Examples of permanent differences include most dividends received from taxable Canadian corporations. They're treated as dividend income for accounting purposes, but they're not taxable between corporations. One of the reasons preferred shares continue to exist is because bankers like to make investments in preferred shares as opposed to bonds, because income on bonds, the interest received on bonds, is taxable, but the interest received on dividend payments from preferred shares is not taxable. Proceeds from life insurance. Proceeds from life insurance is treated as income for accounting purposes, but is never taxable. Well, I really can't say that. Just having taught Business 361, the tax principles course, there are cases when life insurance proceeds can be taxable if the premiums have been deducted. So there are some cases where life insurance could be taxable, but most companies would set it up so that the life insurance on key executives would be non-taxable. So there's a difference between tax treatment and accounting treatment in the proceeds of life insurance in most cases. Compensation expense associated with employee stock options is treated differently for accounting and tax purposes, and it never reverses. So in that case, we don't have any future income tax to account for. There's no future liability, so future liability for paying taxes which we've deferred this period, or any future asset benefit of over-deducting this period and collecting in the future. So permanent differences are things which are recorded on one side but not on the other. Some examples of permanent differences here as well. Non-tax deductible expenses such as meals or fines or golf dues, country club dues, or other club expenses are non-taxable because we can't deduct them, but they are deductible for accounting purposes because they're cost of doing business. Something that's recognized for tax purposes but not for financial accounting purposes, there's a depletion allowance for the extraction of natural resources, which can be in excess of the amount of the cost of those assets for accounting purposes. So there are two theoretical methods for calculation of current income taxes. One is the taxes payable method, which is essentially the check you write to the government is the amount of your current income tax. So it's essentially just the taxable income times the tax rate. This is allowed under ASPE, not under IFRS, because it doesn't account for future tax implications of transactions in this period. The asset and liability approach does account for those future implications of this year's transactions for tax payments, obligations in the future, or tax benefits to be received in the future. So this approach is required by IFRS. It is allowed under ASPE. Major difference is that under ASPE they're referred to as future income taxes. Under IFRS we use the slightly older terminology from a Canadian perspective of deferred income tax assets and liabilities and deferred income tax expense. So ASPE and IFRS use slightly different terminology for the asset and liability approach. Under ASPE, it's called the future income taxes method, and related tax accounts are labeled future income tax assets, liabilities, expenses, and benefits. Under IFRS, the method is called the temporary difference approach, and the related tax assets are referred to as deferred assets and liabilities, etc. So the key issue is future and deferred taxes are used to label them. So a deferred tax liability is the amount of any future tax consequence attributable to temporary differences that will result in net taxable amounts. So taxable amounts less deductible amounts in future years. So a deferred tax liability is a situation where you've used up a tax benefit now and you're going to have to pay for it later. So that would be an example of that would be the CCA versus amortization case, where you get to deduct a larger amount than your accounting depreciation in this period. So you're creating a tax payment that you're going to have to make in the future. So it fits the definition of a liability. It is indeed an obligation that's going to have to be paid in cash in the future. It has arisen as a part of a past transaction, the past transaction being the purchase of the asset, and it will require resources to be expended in the future. So it is an obligation of the company they can't get out of. It's a past transaction and future resource, a future cost of a resource of some sort. So it does fit the definition of tax liability. The tax liability is the amount of tax payable on the net taxable amounts in future years based on the existing provisions of the tax law. Deferred tax assets. Getting a little bit beyond here in my slides. So temporary differences are accumulated timing differences. Over time, they can reverse, and we can add new ones, and so the amount of the temporary differences can change over time as we engage in transactions which have a different treatment for accounting and tax purposes. And so we're looking at temporary differences being the difference between the book value of an asset and its tax basis or tax base. The tax base is specified in the Income Tax Act, so certain kinds of costs would be included. If there are transfers between different taxpayers, that often affects the tax base. Sometimes it applies and sometimes it doesn't. Sometimes it carries over, sometimes it carries forward in reduced form. So it can be quite complicated figuring out what the tax basis of an asset is, but this, of course, is not the tax course, and so we don't spend a lot of time talking about that in this course. So, two types of temporary differences. Taxable temporary differences. So taxable temporary differences are things that will be added to accounting income. So it's basically advancing the recording of revenue or reducing the effect of expenses. So taxable temporary differences are added to accounting income and calculating taxable income. So there's an increase of income between accounting and taxable income. Deductible goes the other way. So things that will be deducted from accounting income in calculating taxable income. So an example of that would be the CCA in excess of depreciation. Deferred tax liabilities are the future tax consequences of taxable temporary differences. So essentially you're adding them to accounting income in this period. I think these two are actually reversed, because if we look at the concept of taxable temporary differences, you add those to accounting income, so you're prepaying taxes in that case, which results in a deferred tax asset. Deductible temporary differences are where you're deducting them from accounting income and calculating taxable income, and so in these cases you're taking a benefit in advance of having to pay for it in the future. So I think these two are actually reversed on this slide. Deferred tax liabilities are the future tax consequences of a deductible temporary difference, and deferred tax assets are future tax consequences of a taxable temporary difference. So tax assets are prepayments of tax. Deferred tax liabilities are future payments of liabilities that you're going to have to make when the timing difference is reversed. So, due to the fact that deductible amounts can arise in the future as a result of temporary differences at the end of the current year, the deferred tax consequences of these deductible amounts should be recognized as a deferred tax asset. A deferred tax asset is the amount of taxes that will be refundable in future years as a result of these deductible amounts. Okay, now let me take a step back. I think I was misreading this slide number 19. These temporary differences, taxable temporary differences, are temporary differences that will be taxable in the future. So they will be added to accounting income in calculating taxable income in the future. So that's a key part there. So that's talking about things that we've deducted now but are going to have have to be added to accounting income in the future. So that would refer to things like CCRA, where or CCRA, things like CCA, things like capital cost allowance, where we've taken advantage of a deduction now, and the reduction in future expenses will result in an increase in taxable income in the future. So we're talking about the future effects, not the effects in this current period. So taxable temporary differences are things which will increase taxable income in the future. Deductible temporary differences are things which will increase deductions in the future. So deferred tax liabilities, those additional obligations which arise from additional taxable income in the future, are future tax liabilities or deferred tax liabilities. And the future benefits which we haven't received yet, those are deferred tax assets. So I think that makes more sense than my first take on that. Slide number 19. Okay, so a key issue in accounting for income taxes is whether a deferred tax asset should be recognized for the accounting or the financial records. So, however, because deferred tax assets meet the definition of an asset, they should be given accounting recognition. They do meet the conditions for an item to be reported as an asset because, first, it will contribute to future net cash flows. So there's a future benefit that's going to be received. Access to the benefits are controlled by the entity. They determine the timing of the transaction and of the claim for tax purposes. So all of those things are within the control of the entity. And it results from a past transaction or event because the time when you actually paid for the asset is in the past. So these conditions are met by the deferred tax asset. It does meet our requirements of asset treatment. So under ASPE, future income tax assets should be recognized only to the extent that it's more likely than not that the future tax asset will be realized. So basically more than a 50% probability that the future tax asset will be realized. Under IFRS, the deferred tax asset is permitted to be recognized only to the extent that it is probable that it will be realized in the future. So generally, the probable means that it's substantially more likely than not. So not just a 51% probability, but something more than that. So the terminology is a little bit different. More likely than not just means anything more than 50.1%. And probable means that it is more likely to occur. So generally, the probable definition would be a slightly higher level of probability, not an exact term. So an evaluation account would not be used under IFRS, but it is or could be used under ASPE. Valuation account is something like bad debts, which is a valuation account for accounts receivable. So bad debts reduces the value. We still keep them in the books because we still want to make sure that we collect the accounts receivable if we can, but we're just allowing for the fact that some of them are not collectible. Under ASPE, that same kind of the idea that we want to make sure we actually take advantage of the future benefit of the future tax asset. We can offset it with the valuation asset and still make sure that we are accounting for all of it. It's the same kind of idea as bad debts expense. Okay, so a deferred tax asset. A deferred tax asset is recognized for all deductible, and by that we mean future deductible, temporary differences. So temporary differences that will arise will cause additional deductions in the future. So however, that being said, deferred tax assets should be reduced if, based on the available evidence, it's probable that some portion or all of the deferred tax asset will not be realized. So when it's judged as more likely than not, which is the term probable under IFRS, if it's probable or more likely than not that some portion or all of the deferred tax asset will not be realized, then that portion expected to be realized should be given accounting recognition, and any portion that will not be realized should be removed and given proper treatment. So probable is defined as a level of likelihood at least slightly more than 50%. So if, say, Angie Company has a deductible temporary difference of $2.5 million at the end of its initial year of operations, it has a tax rate of 45%, then after further consideration, it's considered more likely than not that the tax benefits associated with $700,000 of this deductible temporary difference would never be realized. Then the $1.8 million of deductible temporary difference would stay on the books. The 700,000 would be removed, and the future tax asset would be written off as a loss. So let's look at this deferred tax liabilities example. We have accounts receivable, and this is essentially the example that we had earlier. The accounts receivable is $30,000, but we haven't collected it in cash yet. So for accounting purposes, we have $30,000 of accounts receivable accrued, but for tax purposes, the value is 0. Our tax rate is 25%, and 25% of the $30,000 would result in a deferred tax liability, something that actually, let's back up a second here. Accounts receivable, $30,000 of additional revenue for accounting purposes, not recognized for tax purposes yet. The income tax payable amount for this current period is $10,000. So there's a deferred tax liability at the end of 2017, which is $7,500, which is 30,000 times 25%. When we actually collect that accounts receivable for accounting purposes, it doesn't make any difference to accounting income, but it will increase our taxable income at that time. So we'll have to pay tax at that time. So we don't have to pay tax on it this period. We are going to have to pay tax on it in the future. So therefore, it's a deferred tax liability. Our future taxable amounts in 2018, those are the reversals. So if you remember back to the example, 30,000 was the 2017 additional income. So at the end of 2017, we had $7,500 of future tax payable and future tax liability. And so in 2018, 20,000 of that was received in cash. So that means that we increase our taxable income, but we've already recognized it for accounting income, so it doesn't affect the accounting income. So we reduce our future income tax liability in 2018 by the 5,000. And then in 2019, the reversal of the rest, the other 10,000, is recorded. So that results in the reversal of the last 2,500 of future income tax liabilities. So our journal entries in 2017, we record the current income tax expense at $10,000, and then we also record an additional deferred tax expense of $7,500. So our total tax expense is $17,500, but we have an income tax payable, a check we have to write to the government, and a deferred tax liability, a check we're going to have to write sometime in the future, but not this period, for a deferred tax liability. So essentially, we've recognized the income already. That income is taxable, but for tax purposes, the timing says that we don't have to recognize the other $30,000 until we get around to collecting our accounts receivable. Deferred tax asset example. Cunningham sells microwave ovens with a 2-year warranty. So in 2018, we estimate the warranty expense as $500,000, and we discussed that earlier in this course. So estimate warranty expense of $500,000, and that $500,000 is going to have to be paid out over the next couple of years, but we deduct it for accounting purposes because we match it against the revenue earned by selling the microwave ovens, but the Tax Act says we can't actually deduct them until we pay them as costs. So in 2019, we paid $300,000 to get our microwave ovens repaired under warranty, and another $200,000 in 2020, and so the warranty expense is not deductible in 2018, but it is deductible in 2019 and 2020 as it's paid. So we assume income tax payable for 2018 is $600,000 before accounting for this deferred tax amount. The warranty liability is something that's going to be deductible in the future, so it's a deductible temporary difference. And so $500,000 at 25%, we set up a deferred tax asset of $125,000 in 2018, which is 500,000 times 25%. And then when it reverses, we'll reverse that amount. So in 2018, current income tax expense is the $600,000 for the check we have to write to the government. Deferred tax asset is set up as $125,000. A deferred tax benefit is recorded. So a reduction in the income tax expense, if you will, of $125,000. So the total income tax expense is $475,000, made up of a current tax expense of $600,000 offset by a deferred tax benefit of $125,000. So what is it that we're trying to do with income tax accounting? We're trying to recognize the amount of tax that is payable or refundable for the current year, no matter whether we pay it in the current year or in some future year, or whether we get the benefit in the current year or in some future year. So the amount of tax that's attached to the accounting income should be recorded currently, whether or not we're paying it at some other time. It recognizes the tax effects in the same accounting period as the related transactions and events, and so this is referred to as inter-period tax allocation. If it was between periods, or it is between periods, so therefore it's inter-period. If it was within the one period, it would be called intra-period, but it's inter-period because it's moving the tax effects into this period, even though they're not realized until some future period. Okay, so let's move on to talk about the tax rates. Now, when we're recording deferred income taxes, consideration must be given to the tax rate that's in effect when the timing difference is reversed, because that's when we actually will get to deduct it. So that may be different from today. So normally the current tax rate is used to calculate deferred income taxes. However, if we know that that's wrong, we should account for it properly. So future taxes should be used when such rates have been enacted. So if they're already promised in the budget, so in February or whenever the budget is announced, they promised to change the tax rates for certain kinds of business, and we know that, then the future tax rate should be used to account for the fact that we know that when we actually make the deduction or have to pay tax on the additional revenue, that's the rate that will be in place. So we should use the rates that are expected to apply when the tax assets are realized or the tax liabilities are settled. And so if they're enacted or substantively enacted into law, so they've been announced as a budget by the governing party, then we would adjust the tax differences, the tax assets or liabilities, to account for the change in tax rates. So substantively enacted means that the legislation or regulation has been drafted in appropriate form and tabled in Parliament or presented in Council. So it's on its way, and we know it's going to be enacted. When an unexpected change in the tax rate has been enacted into law, its effect on the deferred income tax accounts on the statement of changes or the statement of financial position should be recorded immediately, with the effects reported as a component of deferred tax expense in the year of the change in rate. So when we get an unexpected change, we will recognize its impact when we see that it has been enacted. So the effect of future tax rate changes should be immediately recognized on all deferred tax accounts as an adjustment to the deferred tax expense or benefit, as the case may be. IFRS requires separate disclosure of the future tax expense or benefit due to a change in tax rates. ASPE doesn't. So in IFRS, we're required to make it clear as a note. So an example, Hostile Corporation had the following at the end of 2017. They had a $300 million balance of excess capital cost allowance. So that's capital cost allowance in excess of the accounting depreciation amount. So we've deducted a whole bunch more. Eventually, that's going to come to roost, and we're going to have to pay it back. So that future taxable timing difference will result in a tax liability. So there's a deferred tax liability of $900,000 3 million times 30%. The temporary difference is expected to reverse equally in 2018, 19, and 20. That would be a somewhat unusual situation since the declining balance is the amount of the declining balance is different each year. But let's assume that for ease of calculation. So 1 million of the timing difference is, or the temporary difference is going to reverse each year. And we're going to assume that a new tax rate is enacted from going from 30% to 25% effective January 1st, 2019. So that's actually better for us because we thought we were going to have to pay 30% tax. Now we're only going to have to pay 25% tax. So we're going to calculate the adjustment to the deferred tax liability and provide the required journal entry. So the adjustment to the deferred tax liability in 2018 is still at 30%. So $300,000 is going to be deducted or reduced from the deferred tax liability. But in 2019 and 20, it's only a 25% rate. So 25% of $1 million would be $250,000 in each of the 2 years. $800,000 is the deferred tax liability based on the future tax rates. Of course, we have a deferred tax liability of $900,000 set up. So we're going to have to reduce the deferred tax liability. To reduce the liability, you debit it for $100,000 and you record a deferred tax benefit. Accounting for income tax loss carryovers. Carrybacks are tax losses which are used to apply against taxable income in the past and reduce the amount of tax that's required. So we get a tax refund for tax loss carrybacks when we apply it. The idea is that a tax loss this period is deductible and is allowed to be carried back because in usually 3 years back and then a number of years into the future, currently 20 years for losses occurring in 2005 and after. And so we can offset the income that we earn in other periods by losses this period because net overall we haven't made any money. Okay, so go on to another slide here. So tax law permits the use of tax losses to offset taxable income in other years, back 3, forward 20. And when applying the tax loss carryback, it's usually applied against the earliest available income. That makes sense because that's the one that's going to expire earliest, right? So the one that is 3 years ago, if there is a taxable income 3 years ago, we would apply it against that first. So the prior year's tax returns would have to be refiled, and that would reduce the prior year's taxable income with the current year's loss. So essentially we record an income tax receivable, a refund receivable, and record a current tax benefit. Okay, so the current tax benefit is a reduction in expense. It's a credit entry. Income tax receivable is a debit entry. If there's more tax loss remaining, then we carry it forward. So we carry it back to 3 years, then 2 years, then 1 year, and then after that we'd have to carry it forward. So a net operating loss. So a net operating loss occurs for tax purposes in a year when the tax deductible expenses exceed the taxable revenues. And under certain circumstances, tax laws permit taxpayers to use the losses of 1 year to offset the profits of other years by allowing them to carry back or carry forward losses incurred. So under these rules, a company pays no income taxes for a year in which it incurs a net operating loss, and it may recover taxes paid in a previous year or reduces taxes that would otherwise be payable in a future year. So there's maybe a benefit associated with incurring a tax loss. A company may carry a loss back 3 years and receive refunds for income taxes paid in those past 3 years. Any loss remaining after the 3-year carryback may be carried forward up to 20 years for losses occurring in 2005 and thereafter to offset future taxable income. So when a company carries a tax loss back, the tax loss gives rise to a refund that's both measurable and currently realizable. So therefore, the associated tax benefit is recognized in the income statement of the year of the loss. So the tax loss this period gives rise to the refund. So that's why we record it as an income tax receivable and benefit of this period. The benefit, once again, is recognized in the year of the loss. When a company carries a tax loss forward, a deferred tax asset should be established for the benefits of future tax savings to the extent they are more likely than not to be realized. So the benefit, once again, is recognized in the year of the loss. If in the year of the loss it's considered more likely than not that the benefits of the tax loss will not be realized, the benefit is not recognized. Instead, the existence of the available tax losses is reported in a note to the financial statements. And if the company does benefit from those losses in a future year, the benefit of the loss is recognized as a reduction of tax expense in that future year. So a tax loss carryforward can only be recognized if it's more likely than not that benefit will be realized. So the company will generate sufficient taxable income in the future to apply the loss against. And so to record the tax loss carryforward, you would record a deferred tax asset and a deferred tax benefit in the current period. To recognize the use of a recognized tax loss carryforward in the next year, when we actually did realize the benefit, we reduce the deferred tax asset by crediting it and record a deferred tax expense by debiting it. If future taxable income is not likely, then we don't record the tax benefit, but we record the existence of the potential loss carryforward in notes, and we disclose the amounts and expiry dates of any unrecognized income tax assets related to the carryforward. So if we're getting close to 20 years and we haven't made any income, it's probably not an issue because the company is probably close to bankruptcy, but we wouldn't have any additional carryforwards. Now, some of the loss carryforwards can actually be sold as an asset, but there are limitations. So if one company is sold to another company, if there's a change in control of the company, that limits the kinds of tax loss carryovers that are available. So you have to be really careful about that sort of thing. So disclosing the amounts and expiry dates of the income tax assets, we'll have to disclose the nature of those unused tax losses. So if the tax loss carryforward wasn't recognized, but the company does generate taxable income in the future and uses up the recognized losses, then all of the accounting happens during the current period in which the unrecognized loss was used. So taxable income, current tax expense, and income tax payable are reduced in the year that the tax loss carryforward is used. If we know in advance that we're going to use it, then we can set it up as a tax asset. If we don't, then if it actually happens, it's an additional benefit which we weren't expecting. So separate disclosure of the tax benefit from realization of unrecorded loss carryforwards is not required under IFRS, but it is required under not required under ASPE, but it is required under IFRS if it makes up a major component of tax expense. So if it's material, you need to disclose it. We may set it up with a valuation allowance, so under ASPE, but not permitted under IFRS. So the example shown here, we're assuming a 20% tax rate on $150,000 carryforward where it's unlikely that the benefit will be realized in the future. We would set up the deferred tax asset as if the whole thing was recognizable. So we would set up a deferred tax asset of $30,000 because that's 20% of $150,000, and the deferred tax benefit would be recorded, and then we would offset it with a deferred tax expense and an allowance to reduce the future income tax asset to expected realizable value. So in this case, we don't think we're going to receive any of it. It's possible we might think it's likely that we would receive part of it, in which case the allowance wouldn't be $30,000. It would be something less than that. But in this case, we think it's unlikely that the benefit will be recognized at all in the future. The second entry above indicates that the company cannot conclude that it is more likely than not that the company will benefit from the tax loss in the future. But the financial statements would be the same because the amount of the deferred tax asset would be shown net of the allowance. So essentially it would be zero. Subsequent review. Each year, all available evidence would be examined to determine whether the entity is expected to benefit from the deferred tax asset which we recognize. And in addition, future deductible amounts not previously given accounting recognition as a deferred tax asset would be considered to determine whether the entity is now in a position to benefit from them in the future. So if you've still got tax loss carryforwards that arose in previous years which you didn't set up as deferred tax assets, you might add some. Or if If you had deferred tax assets which you did set up because at the time you thought it was more likely than not that you would receive the benefit, then those may be reduced if you think it's less likely that you'll receive the benefits under current circumstances. So previously recognized amounts would be written off if it's determined that they're not likely to be received in the future or be realized in the future. Last portion, well, I guess the second last portion, presentation, disclosure, and analysis of the accounting for income taxes. On the statement of financial position, the current income tax receivable or payable are reported separately from deferred future income tax assets and liabilities. So they're reported as current because they need to be repaid, or they need to be paid to the government this period, or they would be receivable this period. So if it's a refund, we would be setting up the receivable. So it's just like any other accrued liability or accrued receivable amount. It's shown on a gross basis unless there's an actual legal right to offset. So you might have taxes receivable from one branch of the government and taxes payable to another branch of the government. So for example, GST, you may have a receivable tax credit that is giving you a refund from GST, but a payable based on your income tax. So you can actually offset the two unless the CRA has agreed to let you do that. Deferred tax and liabilities under IFRS are recorded as non-current. Deferred taxes, assets, and liabilities under ASPE. Future tax assets or liabilities are classified as current or non-current based on the classification of the underlying asset or liability, giving rise to the specific temporary difference. So if it's warranties that are due next year, those would be current. If it's warranties that are due 2 years from now, that would be non-current. If the future asset or liability is not related to a specific asset or liability, such as research costs, which are expensed for accounting purposes but deferred for tax purposes, then the classification would be based on the date that the temporary difference is expected to reverse or the tax benefit is expected to be realized. Income tax expense. Income tax expense or benefit should be allocated to continuing operations, discontinued operations, and other comprehensive income, with adjustments flowing through retained earnings, accumulated other comprehensive income, and share capital as appropriate. And that approach is known as intra-period tax allocation. So that's within the period, putting it into the right categories. So in addition to the significant components of income tax expense attributable to continuing operations should be disclosed as to whether it's current or deferred. So both the current and deferred income tax expense must be disclosed. So, an example, Copy Doctor Inc. has a tax rate of 25%, a loss from continuing operations of $500,000, income from discontinued operations of $900,000, $210,000 of that is not taxable, and unrealized holding gain of $25,000 on investment accounted for at fair value through other comprehensive income. The journal entries to record the current and future tax expenses would be as follows. The current income tax expense on discontinued operations would be $172,000, which is $690,000 times 25%. The 690 is the 900 minus the 210. So 690 times 25%, 172,500 of current income tax expense on discontinued operations. It would be shown in the discontinued operations section of the income. The current income tax benefit on continuing operations is a loss of $500,000 times 25% is a $125,000 benefit. So once again, going back here, we have a loss from continuing operations of $500,000. That's what's referred to there. So the net income tax payable amount is $47,500. That's the check that we will have to be writing to the government at the time we actually pay it. We also have the effect of the unrealized holding gain of $25,000 on the investment accounted for at fair value through other comprehensive income, and that would be this deferred tax expense. The deferred tax expense In other comprehensive income would be 6250. A deferred tax liability would be set up at 6250 on the balance sheet. So there's a $25,000 unrealized holding gain, which it wouldn't be taxable until it's actually realized in cash. So 25% is the amount of this deferred tax expense in other comprehensive income. Disclosure requirements. A company reporting under ASPE can choose the taxes payable method to report their income taxes, and it's a simplified method, so income tax expense is equal to the current tax expense or benefit, and any additional disclosure and reconciliation related to tax issues concerning discontinued operations, the amount of any reserves to be included in each of the next 5 years, and the amount of unused income tax credits and losses. All of that information is still required to be disclosed. If ASPE is choosing to use the deferred or future income taxes method, a company reporting under ASPE would be required to make limited disclosure, including disclosure of when income is not taxed because it's taxable directly to its income or to its owners. So that information would be disclosed separately. IFRS has extensive disclosure requirements as listed here. So they have to disclose more information than ASPE. The major components of any income tax expense or benefits would have to be described. The sources of current and future taxes, the amount of current and future taxes recognized in equity, so the ones which have been recognized in retained earnings, for example. Reconciliation of effective and statutory tax rates when there's a significant difference between what you expect to be paying on your accounting income and the actual amount you're paying, so the current tax expense as a percentage of accounting income. That difference should be reconcilable, so we would reconcile the difference between the effective tax rate and the ones recorded in the Income Tax Act. Any information about unrecognized future tax assets would need to be recorded, so potential cash tax loss carryforwards would be an example there. Any information about types of temporary differences in future tax assets or liabilities which were recognized in the statement of financial position, so you need to describe why it arose. So a company reporting under IFRS using the deferred income tax accounting policy will be required to provide much more extensive disclosure than under ASPE, including information that explains the changes in most of their tax-related accounts, the reasons for temporary differences, a breakdown of any major components of deferred income tax expense. And so, from an analysis perspective, the reason we give all of that extra disclosure is because the extensive disclosures related to current and deferred income taxes aid in assessing the quality of earnings, and they provide better predictions of future cash flows because they tell you about when you expect to actually have to pay tax payable and when you expect to receive cash benefits of cash refunds or tax refunds from the government. Whoops, getting ahead of myself here. There are some outstanding differences or potential accounting issues with the temporary difference approach, or the asset liability method as we've called it. The method's objectives are to record the amount of taxes payable or refundable for the current year, and so taxable assets and tax liabilities and tax assets for the future tax consequences of events that have been recognized in the financial statements or tax returns of this period should be recorded. Although this method is considered to be the most appropriate approach for publicly accountable enterprises, some conceptual questions still remain. We don't use discounting, so we don't actually use the time value of money calculations, and without discounting the asset or liability, financial statements do not indicate the appropriate benefit of a tax deferral or the burden of a tax prepayment. This makes it more difficult to compare the financial statements because a dollar in a short-term deferral is presented as being the same value as a dollar in a longer-term deferral. So we don't actually adjust for the fact that it's going to be either a short-term or a long-term before we actually have to settle up with the government. Recognition of deferred tax assets. Some professionals believe that future deductible amounts arising from operating loss carryforwards are different than future deductible amounts arising from other causes. And so one rationale for this view is that a deferred tax asset arising from normal transactions results in a tax prepayment, which is a prepaid tax asset. essentially. In the case of losses available for carry forward, no tax prepayment has been made. So, uh, so there's a difference in the character of the kind of asset we're talking about. Others argue that realization of a loss carry forward is less likely, and thus should require a more severe test than for a net deductible amount arising from normal operations. Some involved in the International Accounting Standard Board's Conceptual Framework project suggest removing the criterion of probability from the definition of both the asset and the liability, and incorporating it in the measurement of the elements instead. So questions arise about whether deferred tax liabilities are in fact present obligations, and are deferred tax assets really present economic resources. So the question is whether or not we actually have a liability in the case of present obligations, or whether we have an asset in terms of present economic resources. We are waiting for future events to make those realizable, so they're not actually obligations and resources as circumstances exist at the moment. So if these new concepts are applied to the asset liability approach to income taxes, it's likely that different recognition and measurement decisions will result as well. Comparison of IFRS and ASPE and looking ahead. Comparison between the two. The United States, Canada, and the international community all use a statement of financial position or asset liability approach. So for purposes of this course, there are a few differences other than some differences in terminology between different countries. ASPE also uses the taxes payable method for its simplicity. So if you're interested, look at illustration 1844 in the text to see a comparison of this terminology differences, as well as any differences in recognition, presentation, and disclosure. Looking ahead, in March 2009, the IASB, International Accounting Standards Board, issued an exposure draft of a standard to replace International Accounting Standard 12 on income taxes. The intent was to eliminate many of the differences between IFRS and FASB standards, FASB being the Financial Accounting Standards Board of the U.S. The 2009 exposure draft also dealt with accounting for uncertain tax positions, so talking about how to handle uncertainty in tax measurements. It's kind of the idea of the probability, whether it's probable, more likely than not. In December 2010, the IASB decided to narrow the scope of the income tax project, but left open the possibility that a fundamental review of the accounting for income taxes could be part of a future consultation process. In August 2014, they issued another exposure draft that proposed amendments to IAS 12, entitled Recognition of Deferred Tax Assets for Unrealized Losses, that clarifies the recognition of deferred tax assets that relate to debt instruments measured at fair value. In July 2015, IASB indicated that it planned to issue the final amendments to IASB related to the August 2014 exposure draft by the end of 2015, with a January 1st, 2017 effective date. And then they noted in their 2015 work plan that IAS 12 has been criticized as being difficult to understand, resulting in many problems in practice. So in addition, it launched a research project in 2015 with the goal of better understanding the needs of stakeholders regarding income taxes. This leaves the process open for further changes to accounting requirements for income taxes. And that is it for Chapter 18.